Hello, and welcome to the Rise Broadband Put Your Company 401k Plan to Work for You. The purpose of this meeting is financial wellness, and I'm here to talk to you about the benefits of your 401k plan at Rise Broadband. My name is Mark L. I'm with Alpha Capital Management Group. My role as your financial advisor is to help you understand the long-term benefits of your 401k plan. It's not to leave you overwhelmed or to create anxiety, but to coach you through sound decisions to help set up for retirement from enrollment all the way through proper investment decisions and retirement planning. So whether you are young and this is your first 401k opportunity, or whether you're currently enrolled in your middle years or getting close to retirement, your 401k is an important part of which you will rely on to draw income from in retirement. Statistically, your 401k account balance can be up to 40% of the money you will count on in retirement, along with Social Security and other outside savings you accumulate. So if you are currently enrolled, that's fantastic. If you are not utilizing your 401k plan benefit at Rise Broadband, my goal would be to create a call to action to help you understand the importance and get yourself enrolled in the 401k plan and start to accumulate a balance for your 401k retirement account balance so that you've got some money to draw from when you retire. Rise Broadband has chosen Empower Retirement as your 401k provider. Empower Retirement is located in Denver, Colorado as its national headquarters, and it is the second largest 401k provider in the United States. We have been lucky to work with Empower Retirement as they have one of the best website portals for you as a participant to navigate through your investment planning and your retirement planning. Empower Retirement does 401k plans such as Southwest Airlines, Colorado Rockies, Denver Broncos, and even Apple has their 401k plan at Empower Retirement. So we are fortunate to be along with one of the greatest providers in the U.S. to help you manage your 401k account. If you need to enroll or are already enrolled, you will see that Empower Retirement has a great website and mobile apps and an easy user interface. One of the first items I wish to discuss is 401k basics. Let me walk through some of the basic information about your 401k plan. My goal is for you to see the 401k opportunity in a different light and to create a call to action to put yourself first in line, to pay yourself first, and really pay attention to saving for retirement and realize the power of your 401k plan. Back to 401k basics, let's discuss how your 401k plan retirement accounts are made available to you. First, let's start with eligibility. Eligibility time frame is 1 month following at the first of the month following your first month of employment. So it's a relatively quick eligibility time frame. Enrollment is done online. In other words, it's not an auto enroll. So there is a call to action on your part to take that first step by creating a username and a password at the Empower Retirement website. Essentially, you're going to be asked to answer 4 questions. The first one is, am I ready to participate and start my 401k account savings, or no, do I want to wait until another time? So hopefully the answer is yes to that. That's question number 1. Question number 2 is how much? In other words, your 401k plan is designed to have a paycheck withholding which goes right into your 401k account, which makes it super easy. For those of you that have direct deposit and don't utilize the 401k plan, it's really hard to say because once that money hits our checking account, we typically, as Americans, find a way to spend it. So by virtue of the 401k plan and being it directly tied in with your payroll, you're automatically saving from your payroll contributions, and then anything left over, of course, will go direct deposit. So it's an easy way to save. So going back to question number 2 on the how much question, let's talk about maybe a jump-off point of 5%. And I'll show you some scenarios that will show you how your take-home pay is affected with just a simple 5% contribution. I can also advise that the national average for 401k plans across the United States is around 8%. So use 8% as a watermark for a savings level from your paychecks as to what the rest of America is doing on average. The third question that you'll answer during the enrollment process is whether to do pre-tax traditional contributions or to do what's called Roth after-tax contributions. Now, most of us in America do pre-tax contributions because it allows you to put money in from your payroll without it having been taxed, and it allows it to grow tax deferred and until retirement. Now, in this pre-tax approach, because you're not taxed on those dollars, it's not going to affect your net take-home pay as significantly as the Roth after-tax. By virtue of choosing the Roth style of saving in after-tax dollars, you are simply doing just that. You're putting in after-tax dollars into your account. And the reason why people will do that is because they're seen as being in a low tax bracket currently, and I just as soon pay that lower tax rate today. Therefore, when I do retire and pull money out, it's all mine. There is no tax coming out from distributions in that Roth account. Stated another way, going back to pre-tax, just know that if you were able to realize the tax benefits of the pre-tax contributions going in, then alternatively, when you do retire, that's when Uncle Sam will take tax from your distributions at point of retirement. So look at it this way, Uncle Sam's going to collect tax either way. If you choose pre-tax, Uncle Sam will collect tax from you at point of retirement when you distribute the money. If you choose Roth, then you're going to put in after-tax dollars and not pay any tax on the distributions coming out. So that is the third question that you'll tackle. The fourth one is, where do I invest? In your 401k plan, you have many investment choices. And my goal as your financial advisor at Alpha Capital assigned to your plan is to help you with that decision. That tends to be where most of my call to action will be able to be of most benefit for you. And you're going to be able to give me a call or send me an email for me to help you out one-on-one and directly in your circumstance. I do have view access to your website. I'm not able to change anything, but if you and I have a conversation over the phone, I can look at your account and help steer you in the right direction given your personal circumstances. So again, the fourth question of how do I invest or where do I invest in my mutual fund choices in my 401k plan tends to be the fourth and final question of which you will answer during the enrollment process. Keep in mind that any of these decision points can be changed. So whether it's enrollment, whether it's the how much, whether it's pre-tax or Roth or investments, that when you enroll, don't feel like you're stuck with any of these decisions. These are things that you can change along the way. It's more important to take the actions to get enrolled and then make modifications to your account. You will also declare a beneficiary when you enroll online, and that is going to be the person or persons you designate if you were to pass away, where your 401k account balance will move to. It's important to name a beneficiary and to keep that updated as life changes to make sure that that's always stated and accurate. Your 401k has advantages over an IRA. One of the biggest is the availability of the money in your 401k account comparatively to the IRA. The 401k has loan options, which is the ability for you to borrow money from your 401k plan and pay yourself back with payroll payments. Now, keep in mind, this is not an advisable strategy. I certainly don't want to leave the intent that this is going to be a my car broke down fund or a holiday Christmas fund or short-term monies. These are long-term monies meant not to be touched until you retire. But again, there is availability by virtue of loan and even what's called hardship for you to access your monies. These are provisions in 401k that are not available in an IRA. Now, if you take money from your 401k plan and say simply just cash it out, just know and understand there's going to be a penalty. So if you're younger than age 59 and a half, if you retire, if you take money out of your account, you're going to pay a 10% penalty, and you're going to also pay the tax on the money that has come out. So keep that in mind, that there are some restrictions on removing money from your 401k plan if it's not by virtue of loan and or hardship. The other point I want to recognize in difference between 401ks and IRAs are the contribution limits. The limits in 2019, this current year, are $19,000 per year. That's the most that you can contribute into your 401k account. If you are over age 50 and a half, you get what's called a catch-up provision, which allows you to put in an additional $6,000 more, totaling to $25,000. So again, the 2019 limits are $19,000 and $25,000 if you're over age 50. In an IRA, the limits are only $6,000 if you're under age 50 and a half, and then an additional $1,000 or $7,000 if you're over age 50 and a half. You can do both. So you simply can do a 401k plan through Rise Broadband and still contribute into your IRAs concurrently. There's certainly nothing wrong with doing that. But most individuals don't ever see even reaching $19,000. That's our goal, of course, but most of those limits don't ever get captured. So it's almost easier just to contribute into your 401k plan into one account. Your account is portable. Your 401k is portable and meant to move with you through your working career. These accounts are your monies. As your financial advisor with Rise Broadband, my goal is to make sure that that you're saving for retirement and that you understand that these are your monies. As much as I want you to enroll, you're not sending your money to me. These are monies going from your check into your account. Simply view me as your coach. If you ever did leave employment at Rise Broadband, you're going to be welcome to move these monies in your 401k at Rise Broadband to your new employer's 401k plan. Or if your new employer does not have a 401k plan benefit, you can always move it into an IRA or some other qualified account. What we would rather not see you do is cash it out. That would destroy your ability to save for retirement. We want to make sure that these monies stay intact and to avoid paying any penalty or tax. So let's take a look at Pay Yourself First sample paycheck. The reason why I want to put this example out there for you is to take a look at what is my paycheck going to look like or potentially look like if I start contributing to my 401k. Most people are very sensitive to your net take-home pay because you have to pay bills, and I understand the pressures of keeping everything paid up and your finances from month to month current. But by virtue of the 401k plan and your pre-tax, all I want to do is convey a simple paycheck scenario so that you can see and understand that you can save in your 401k plan with a little lessened effect on your net take-home pay. So let's look at the upper left-hand box. This is a scenario where you're not saving in your 401k plan. And I picked a $1,000 paycheck just for easy math and a 22% tax rate. This example is also going to be with an 8% 401k contribution, which will be the right-hand side box, which I'll get to in a second. But assuming $1,000 gross earnings, your taxable wages, of course, are $1,000. Assuming a 22% tax rate, that would be $220. So your net take-home pay is $780. Again, this is a very simple scenario, not including any other deductions that you might have and so forth. Now let's look to see what it looks like if I were to enroll at 8% in the 401k account under the pre-tax traditional method. What happens with your $1,000 paycheck and an 8% pre-tax contribution of $80, the government is only going to tax you on $920 of earnings. They're going to carve out that $80 in what's called pre-tax. So assuming, again, that 22% tax rate, your taxes are only going to be $202, not in the previous example of $220. So your net take-home pay is $718. So that difference between not participating and participating is only $62 as it affects your net take-home pay, yet you're able to save $80 in your 401k account. Now keep in mind, you can do the Roth style feature. That's a different scenario than what I've got here on screen, which would be an after-tax contribution, of which your net take-home pay would be more indicative of the left-hand side box. As I mentioned earlier, Empower Retirement, in my opinion, has the best web interface of all of its competitors. I've noted at the top of this screen the phone number and the website address for you to create your account and to enroll. So this is a very important website URL that you want to make note of. When you enroll, the payroll of which you want to start your contributions will begin to withhold from your check in about 1 to 2 pay periods, depending on the timing of it all. So note that when we look at this website, the first thing that I pay attention to is the gray circle on this screen. This is a sample website with the a fictitious employee of Taylor Smith, and as we can see, she's got $25,482 in her account, and she is at 61% of her goal. What we're wanting to do and try to accomplish is what's called a retirement income score. And so many people will ask, well, how am I doing? And by virtue of this website, you can actually model out some goals for you to achieve what's called a retirement income score that most would exemplify the ability for you to have a dignified retirement. The number in that gray box should be somewhere between 80 and 100%. So by using some of the intuitive sliders that we have on this website that you can play with are to affect your contribution amounts and to affect your retirement age. That's noted on these slide bars here in the lower left-hand side. And as you can see, there's an edit button on there. So in real time, the current contribution rate for Taylor is 4%, but you can slide that scale to the right and get up-to-date information as to how it's going to affect my retirement income score. So by virtually going from 4% to maybe 6%, or maybe the national average at 8%, even at 10%, you're going to see your retirement income score increase to get you more in tune with what your retirement looks like, to make sure that you have enough to pay yourself in retirement to cover all your living expenses. You can also change your retirement age. Currently, it's set at a default rate age of 65, but let's just say you have good health in your family and you want to work to age 67 or even age 70. By moving those years of work forward into those later years, you're also going to see your income score rise. So this is a great way for you to really get a future look at what sort of estimated monthly income it's going to look like in retirement. Right now, what you see on screen on an estimated monthly income is $2,087. So if that amount of money per month looks good to you, then 61% might be okay. My guess is that that number is too low. Very few of us can live on $2,000 a month. Even with adding Social Security would be very tight. So by using those sliders, you can play and make adjustments to your 401k account. Now, what happens if you go from 4% to 6%, that number will be conveyed to the HR department, and it's either going to change on your next pay period or the pay period thereafter, of which those new contribution rates would go into effect. So there is some integration there and some communication from your 401k site right back to your payroll software. Look at the estimated retirement income bars that are noted in green, blue, yellow, and red. So what this is going to convey is an estimate of your current savings, which is green, your employer contributions, which may or may not exist. It'll also tabulate Social Security and what's called your income gap. Obviously, that's noted in red. So in order to close that income gap and get that number from 61 to a higher number, you'll see the sliders will change these colors to get you more in tune with what's expected to be a most normal estimated monthly income for you to retire. So it's a great website, and it puts you very much in touch with calculating retirement income and gives you a look. You can include other assets. There's a place right here on the screen that says other assets. There's a tab where you can add in outside accounts so that the software knows to look at not only your 401k plan, but other accounts that you have saved for retirement, such as IRAs or outside savings. So you can get more involved with your retirement planning by simply utilizing this web portal. You can change your health status in this particular website. In other words, you can designate the state that you live in, answer some health questions, and it'll also modify that score based on your current health that you have. So it's a great website for you to be involved with. You can't ruin anything by going onto this website. This will be the user interface that you'll see first up when you enroll and you log online. The functionality of this website is also where you're going to be able to change your investments. You're going to be able to update your beneficiaries and so forth. So it's a great website, and I would encourage you all to become involved with it. I also want to let you know that Empower Retirement also has a mobile app. Most of us have cell phones, whether it be Apple or Android, and to let you know that Empower Retirement has applications for both. With the iPhone, it is an app that you can download, and it has complete user functionality as you would if you were on the main website. So the ability to check your balances, make changes to your account, check your investment rates of return, and so forth. All that's available with the iPhone app. If you are a Droid user, then you simply go to the website at Empower Retirement. It's not an app, but all of the screens are formatted to fit your phone and has, again, the complete functionality as if you were on the main website. Do you have an old 401k account or an IRA to roll over? In my past experience as a financial advisor, let me share you some stories that have come to me with lost 401k accounts. It's not uncommon for me to get a phone call from a 401k participant, and the conversation goes like this. I remember working for a company about 8 years ago, and I'm pretty sure we had a 401k plan, and I thought I was contributing, and I'm not sure if I even have a balance there or not. And in other words, there could be the potential for some lost money that's sitting out there. And as absurd as that may seem, it's actually fairly common. So what we're trying to avoid, and what my message is to you, is that if you have older 401k accounts or even IRAs that you're not necessarily paying attention to, you are welcome to consolidate those accounts into your 401k plan at Rise Broadband. And to do that, there's a team of people at our provider at Empower Retirement, and if you call them at the number on the screen that's in the red box, it's 888-737-4480. Their goal is to assist you with that rollover. It's important to do that as it's your responsibility to keep track of your accounts. It's also customary, again, you can move your IRAs into your 401k accounts as well. So it doesn't have to be a 401k to a 401k here. It can be your IRAs as well. A couple of things that you can prepare for are to get a copy of your most recent statement from your older accounts if you have them, and that'll help out in the conversion process. What Empower Retirement will do is they will call the provider of where the old account is, and they'll have you on the phone as a three-way call. They'll virtually fill out the forms online and send you applications and forms to sign, and it's very seamless and it's very straightforward, and it's very, very easy to do. So take advantage of the account rollover functionality at Empower Retirement, consolidate those accounts. It's great housekeeping, and it's something that you most likely will pay more attention to if you have your 401k account at Rise Broadband consolidated with all of your old retirement accounts. Let's sidestep into some more conversations about investment education, which is the heart and soul of some of the information that I want to convey from here to the end of the presentation. Let's look at the power of time and discipline. On this particular screen, you have three investors: Investor A, which is green, Investor B, which is teal, and Investor C, which is blue. Now notice, I tend to look at the numbers on the right-hand side of the screen, and those are some significant large balances. 940,000 for Investor A, 872 for Investor B, and over 1.8 million for Investor C. Well, wouldn't we all want to be like that? Well, there are steps to allow you to get there. This is an example. I'll start with Investor A. saving from age 23 to age 32, which is only a 9-year time span. This individual saved $5,500 per year. So maybe this would be indicative of a person making $55,000 a year and saving 10%. So over the course of those 9 years, a total of $49,500 was invested, but for some reason, investor A simply just stopped. But by virtue of compounding of investment returns in the account, you can see that even by not contributing into a 401k account from age 32 all the way to 65, by compounding of money, accumulated that $50,000 invested to almost $1 million. So that's a very, very powerful tool that you can utilize when you invest in your 401k. Now, investor B has a little bit different scenario and maybe most indicative to many of us. This investor B did not start saving from age 23 to 32. They got a little bit later start. Maybe there was student loans. Maybe there were some tough years where earnings were a little bit on the low side and just found it difficult to save. But by age 32, decided to enroll. Investor B also saved $5,500 per year, but had to invest for 34 years all the way to age 65. And during that time, actually contributed from payroll $187,000. But through compounding of investment returns over historical averages, $872,000 was the account balance at age 65. So when you compare investor A and investor B, it almost appears that investor A has the leg up, even though only after investing for 9 years as opposed to 34 years. So the message here is get an early start. Most individuals that are in their 50-year-old categories and maybe haven't done a very good job savings will tell you, I wish I had time back. Obviously, that's not something we can do, but the message is for younger individuals in their 20s and early 30s is if you are saving, that is going to give you the best chance for a solid retirement. Certainly, investor B has a nice retirement balance. It just took a lot more effort to get there. Now, lastly, investor C, which is the star hero in this category, invested from age 23 all the way to the end of their working years at age 65. They invested the same amount, $5,500 per year, for 42 years and has just under $2 million in their retirement account. So that's the model that we're looking for and would like to advise you to become that disciplined in your working career, is to start out right at your first job and continue to invest very disciplined and steadfast throughout your whole working career and save that type of money. Again, in this sample, it's $5,500 per year. If you can do more, fantastic, but the outcome looks very, very bright. So let's take a look at some more investment education. This is a chart of the S&P 500 index and a 20-year look back from 1997 all the way to 2018. When I see this chart, I think of it as almost like I'm looking at a heart monitor. You can see that the index of the S&P 500 goes up and down, just like the heart monitor scenario. In 1997, if you look at the bottom timeline, it has moved up from 97 all the way to the early 2000s. Then what happened is we had what's called a tech bubble, and the markets actually went down for a few years up until about 2003. And then we're on a steady incline all the way up into 2008. Many of us remember 2008-9 as what we call the Great Recession in our country, which lasted a couple years. And then since 2009 has been a longest bull run that we've ever had in market history. And as you can see, the very long trail of upward gains all the way to current year. And so keep in mind that the main message on this screen is that investments do go up and down. There are warm days and cold days, just like the temperature drops up and down. And the news that we read, see, and hear on television and on radio will give us plenty of feedback and data as to whether we should be invested or not invested. Again, the simple message is that investments do go up and down, even to the point where I need to mention that investments do lose value. So your 401k account balance is not guaranteed to always just go simply up. Now, if we look at historical market returns, you can expect an average rate of return over the long term of around 7%. And so when we look at returns in the market, we try to focus more on a 3-year, 5-year, and a 10-year outlook. Again, in your 401k plan, since these are retirement monies, we try to have you stay a little bit disciplined in your approach and not necessarily pay attention to the day-to-day news, as it will create a lot of anxiety for you. So stay emotionally in check and understand that long-term investments are our ultimate goal, and that we're saving for retirement. So to reinforce the long-term investment strategy in a 401k plan, here's a slide with some information on a plan to stay invested. The reason why I wanted to show you this is because I wanted to support the long-term average of around a 7% return in the historical market averages. This is information that's being deployed in this particular chart from January of 1998 all the way to the end of 2017. So it's a 20-year look back. The bar on the far left, the gray bar on the far left, has 7.2% rate of return, which has $10,000 invested turning into $40,000 on a fully invested 401k account. The reason why it's best to look at this as a long-term investment and not to necessarily change your investment strategy is that if you look at the second bar, which is basically missing the 10 best days in the market, you would have cut your return in half. So what happens is that a lot of investors try to time the market, and that's something that we try to steer 401k investors away from. So by missing 10 of the best days and saying, look, I really feel the markets are going to be bad this quarter or this month, and I'm going to park all my money in cash. And then maybe you do that, and then you realize that there were some really good days, and then you're saying, well, I think I'm going to get back in and invest again and be more aggressive in my investment strategy. It would be a bad approach. So again, by missing only 10 of the best days in the market, you would cut your return to 3.53% from the 7.2. If you've missed the 20 best days, it drops in half again to just 1.15%. So staying invested in your risk tolerance categories is the most important thing, as opposed to moving in and out of the markets from cash to investments, because it's almost virtually impossible to time the markets as to when these good days are and when the bad days are. Note in the box, 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So that's something very important. So when you see negative news and you see big drops in the stock market and you see your 401k account goes backwards, if you wait within a few weeks, normally you can have some of the best days on a rebound. So these ups and downs are what we call market volatility, and we've seen that a lot recently. Just know that it's important not to bounce around your investments too much. Let them stay long-term and stay fully deployed over the course of time. You should have market expected realized returns of around 7.2% over the course of time, as long as history repeats itself. One of the most important things that I can do as your financial advisor is to give you the best possible investment choices that I believe, based on some market analysis of how you can deploy your investments in your 401k plan. What you're seeing on your screen is an investment allocation guide. It'll note all of the investment choices in the left-hand column that are in your 401k plan. It'll also show you the asset class, which is the second column. And then the way I've laid this out is you have a larger top box and a smaller box at the bottom, which houses your American Funds target date funds. What I'll do as a financial advisor for Rise Broadband is I will update this quarterly investment guide every quarter. This one's dated October 2018. In your hands in the matter of a few days. You're going to have the January 2019, and subsequently every quarter, so January, April, July, and October, I will recast this investment guide, send it to the HR team, of which they're going to deploy this on your website for you to use as a guide in case you want help picking your investments. Because 401k plans are discretionary, the call to action on your part is you're able to follow this advice, of which you would have to log online to change your investment choices. You're certainly able and capable of picking your own investments, but for those that want help, this is a great tool. So let's concentrate on how to better use this chart. Notice that there are 5 risk tolerance columns in that larger box, from conservative, moving over to the right, all the way to aggressive. Right above those categories, you're going to see a number, such as above aggressive, you're going to see 80-20. What that means is that those investments in that column are based on 80% stocks and 20% bond as a mix. Inversely, in the conservative column, it is just the opposite. It's 20% stock, 80% bonds. So in other words, the idea behind either conservative, moderate, or say aggressive is the mixture and the allocation mix of what we call the stock to bond ratio. Stocks are where you get your returns, but it's also where you would get your losses. They're the most volatile. Bonds typically and can go up and down, but at a much lower level. So if you notice, the moderate column is exactly 50-50 mix of stocks to bonds. And so by virtue of your personal risk tolerance, some of you are conservative, some people are aggressive. In order to find out what sort of risk tolerance palette that you individually are, you can go to a Google website search box and just simply type in risk tolerance. And you can take some online models to figure out how your risk tolerance is simply by answering anywhere from 5 to 10 questions on your risk tolerance. Now, the most common advice that I would give individuals is to take the number 100 minus your age, and that would be an appropriate risk tolerance model. So if you were 30 years old, or say 35 years old, you would take 100 minus 35. That would put you in the moderate aggressive column, because 100 minus 35 is 65. That would be the amount of stock ratio to bond that would be appropriate for you. So we do see typically younger investors in their 20s and 30s and even 40s be somewhere in that moderately aggressive to the aggressive category. If you're age 50, that would be a perfect moderate category. And as you get into your later 50s and 60s, that's where people would tend to migrate towards those conservative or moderately conservative risk tolerance models. So again, every quarter, you're welcome to use this guide based on all of the research data that I have. This would be the best way to deploy your 401k contributions to build an asset allocation model that's appropriate for you. Now, reaching out to the lower side of that box, you see the American Funds Retirement Funds, and they're based on vintage year classes of, say, 2020 all the way up to the vintage year 2060. And the way to utilize these target date funds would be strategy B, if you will. So strategy A would be the top box, strategy B would be the lower box, of which then you would pick simply one target date fund indicative of the year you would reach age 65. So if I turn age 65 in the year 2040, I simply would choose that mutual fund at 100%, meaning that my 401k contributions from my paycheck are going to go solely into that one single sole mutual fund. And that is a fantastic strategy. So I like both strategies, A and B, the top box and the lower box. It simply depends on your methodology of how in tune you want to be with making investment choices and changes from quarter to quarter, or the American Funds Retirement Strategy, the target dates, which is a single choice that can last you long periods of time. It's meant to be a long-term single choice pick. So For further explanation, the American Funds target date funds are built on a glide path. They're built very aggressively, such as in the target years 2060, 2055, 2050. That aggressive model is for those younger people that have long working careers. There's a glide path involved with these target date funds, which takes it to a more conservative approach over time. So that glide path is on autopilot. And that's why a lot of people like these target date retirement funds, is because of that automatic glide path. So that's a great strategy, and a very common strategy for people in 401k plans is to choose the target date funds. So either way, both strategies are available to you. My goal as your financial advisor is to make sure that you have some flexibility in how you choose your investments. And my contact information is on the lower left-hand side of this chart. You can see my phone number at 303-900-1935, as well as my email address. So that is my personal contact information if you have any questions regarding investment choices in your 401k plan. The final piece of investment education that I want to convey to you is disciplined diversification. What you're seeing in front of you is what I call Grandma's quill chart. It's simply a colorized chart of all the market sectors' rates of return on a 20-year look back. The idea here and the understanding to the investors that are out there is to not chase returns. So in other words, it's real common to log into your 401k account and look at how the mutual funds have been doing historically on a current year, 1 year, 3 year, 5 year look back in their rates of return. So the most common investor will look at a mutual fund and say, wow, that mutual fund did 10% last year, and the one that I'm currently invested in only did 5. So I'm going to change my 5% and go after that one that did 10. And that's what's called chasing returns. So the reason why I want to show you this chart is that just because that mutual fund choice did 10% this year doesn't mean it's going to do well next year. Likewise, it doesn't mean that the one that you were in that currently only did 5% is going to necessarily rebound and have a good year next year. So because their investing is unknown, the best way to capture long-term market average returns is what's called a diversified portfolio, which is the black box that goes right through the middle. Now, the way to utilize this chart is to pick a color on the very left-hand side and then simply follow it throughout the years from 96 all the way to the end. And as you can quickly see, there's not one sector in the markets, whether it's large cap, small cap funds, commodities, international funds, global bonds, and bonds, that holds any sort of consistency from year to year, with the exception of the diversified portfolio, which exemplifies 65% stocks and 35% bonds, which in my previous chart is the moderately aggressive category. And what it'll show you is that it provides the most consistent returns over time. You're never going to guess the highest of highs in any given year, but you're also not going to realize the lowest of lows in any given year. So it's a bit of a boring approach to stay in a diversified portfolio, but it's going to provide the best long-term consistent average rates of return and leave you without guessing which sectors of the economy are going to perform. So it's a great way to know that trying to guess the markets, try to know where that holy grail of investing in just isn't something that we're going to be able to guarantee or pick for you. So that diversified portfolio might be your best approach. I want to thank you for your time today. I hope you found this beneficial as it relates to some of the information about your 401k plan at Rise Broadband, along with some investment education and the ability to provide you with information that you either knew or maybe you didn't know. I want to convey thanks for your time. I also want to convey that we're going to post more of these educational sessions that will dive more into topics such as budgeting and retirement planning, and post these on the website for you to utilize at any time that's convenient for you. As you can see, my contact information is right here on the screen. You're welcome to call me or send me an email for me to help with you individually. and I hope you have a happy, safe investment journey. Thank you for your time.